Yields back. Mr. Stivers.
Thank you, Madam Chairwoman. I'd like to enter two things into the record. One, a letter from Senator Collins. The other, a letter on behalf of regional banks and some
Without
of the challenges
objection.
that they face. Thank you. My first question is for Mr. Gibson. Mr. Gibson, do you believe the Dodd-Frank law requires you to apply capital rules identically to insurance companies as banks?
No, we only apply capital requirements to depository institution holding companies, which includes ones that happen to own an insurance company. And we have tailored in the proposal.
I guess I'm sorry if I was not specific enough, but where there are insurance company assets, do you, inside a bank holding company, do you believe that it requires identical capital to as if that was a bank asset?
No, and we tailored the proposed requirements to insurance businesses in several areas, for example, separate accounts and policy loans. However, we are constrained by the Collins Amendment, which sets a floor on holding company capital requirements equal to what the bank capital requirements are.
I have a letter from Senator Collins to your boss that says that she believes that they can actually, within the constraints of her amendment, sort of work with the standards and work with folks like NAIC to make sure that the standards are appropriate for insurance companies. So I'd ask you to take a look at that. I submitted it for the record. My second question for you is, what credit do you think state-based regulation and state-based risk capital should be given to insurance companies because they have state-based risk capital? And when those laws conflict, do you think you actually supersede the state laws? Because I don't see that in Dodd-Frank.
No, so what we do is we're setting a capital requirement at the holding company level, and at the level of individual operating companies, whether it's a bank or an insurance company, there are separate capital requirements by the functional regulators. And specifically with respect to insurance companies, they have capital requirements set by their insurance regulator on insurance underwriting risk, for example. We don't set any capital requirement on that. We just take the number that comes out of the state insurance regulatory system, and we just plug that number into ours.
And there's going to be additional systems cost to folks that happen to own insurance assets that they don't have today because they currently calculate their capital based on the state-by-state approach. Did you calculate any of that into your costs when you did your cost-benefit analysis?
I mean, we generally consider the impact of what we proposed, but we have heard comments, especially from depository institution holding companies that own insurance companies, that they would need more time to adjust to the changes because the changes would be greater for them. They were not subject to this kind of consolidated regulation before. Correct.
And I didn't see anything that allows you to do that. Are you working hard to make that happen? That's a yes or no question because of my limited time.
We've heard those comments, and we're working to incorporate them as we go forward.
Great. My next question is for Mr. Gibson and Mr. Lyons. Somebody before said it's really the activities of the bank, not the size, that determines the risk. And I'm really worried about misascribing the cost of risk, especially associated with mortgages and home equity lines of credit, especially with regard to the qualified mortgage, which has yet to be completely defined. That's come up a little bit before, but can you talk about what you're going to do to make sure that we don't misascribe risk, because if we do, it's going to drive up the cost of credit and limit credit availability.
Congressman, we attempted to calibrate risk based on the performance of those assets through the crisis. We've received comments from many banks and institutions that we need to take a second look at that, and we will as we go through the process. But we attempted to calibrate the risk based on the performance of those assets through the crisis.
Is there any way that you can finalize this before the QM definition is defined? Because I don't think if you're really going to do that, how can you finalize this rule before the QM rule is finalized?
That's a good point. In the proposal, there's two categories of mortgages, Category 1 and Category 2. Category 1 closely resembles what we think will come out of QM. But we are working very, very aggressively to review all comments and come up with a final proposal.
And that kind of brings me back to, and I only have 10 seconds, the problem with this requirement is it's so complex and granular that it has interplay with other regulations that are only in proposal stage, and you know, it could be very problematic, very difficult to implement, and in fact contradict with or just not give credit to some of the other regulations that other regulators are spending a lot of time and effort to get right. So I would hope you would be mindful of that as you proceed on this course.
Thank you. I want to thank the gentleman.
Thank you. I yield back.
Thank you. That concludes
Thank you, Mr. Chairman. I will yield my spot in line to the gentleman from Ohio if I can pick back up after him.
Certainly.
He's got another committee to go to. Thank you,
All
sir.
right. Mr. Stivers.
Thank you. I appreciate the gentleman from Missouri for allowing me to scoot up a little bit. I appreciate all the witnesses' testimony. My first question is for Mr. Poston. You talk about in your testimony about the concern about the standardized approach for risk weighting, and you know, I was really taken by a point you make on page 7 about how some non-performing loans actually are seen as less risky than home equity lines of credit and other mortgage products. Would you like to talk about that a little bit? Because that does seem incomprehensible that a non-performing loan would be less risky than a loan that is performing.
Yes, I think your question gets to a point that I think has been one that many in the banking industry have focused on, and that is the treatment of mortgage loans and the treatment of home equity loans. And the risk weighting with respect to those categories of loans has been made excessively more complex than it has been under prior rules, and very punitive in the view of most in the industry. So the example that you point out gets to the inappropriateness, in our view, of the risk weightings of mortgage loans and home equity loans, and what we believe will be have a significant negative impact on our customers in terms of the availability of that type of credit, as well as the cost of that type of credit.
Thanks. And with regard to that, the sort of a formulaic approach to risk-based weighting, where the regulators assume they know exactly what the risk of every potential problem is, seems to me like it's very problematic, because in my experience, I've been in the Army 30 years, and the generals always want to fight the last war, and this appears to me like we're creating a Maginot Line that the regulators today believe is impenetrable, and as we all know, in World War II, they just found another way, and we don't always judge the right crisis. Does anybody else want to talk about the concerns of sort of the standardized risk weighting? I know that in Mr. Loving's testimony, it was something you addressed. Is there anybody else that has concerns about a formulaic approach where we pretend to know exactly what the risks are in some mathematical formula? And Professor's shaking her head. Maybe she would like to address something too. Mr. Loving first, maybe, and then the professor.
Oh, sure.
Yes, you know, when you look at the standardized approach and the risk weights that are applied, it does create some question as to the real estate marketplace and the risk weights that are placed on certain real estate loans versus other components, whether it be commercial loans or home equities. They all carry different level of risk, but I'm not sure that 200% risk weight is the appropriate level on a balloon mortgage or even a home equity. So.
Go ahead, Professor.
Yes, it seems like they're fighting the last war in a very narrow way. They're not learning the really big lesson, which is more what you said, that it's an illusion that we can measure these things, that there are a lot of things that it's sort of about black swans, it's about unknown unknowns, it's about having an actual buffer. Even in the stress testing, by the way, there's a lot of reliance on models.
Right.
How would you predict, and do you know the contagion mechanism, and do you really know what AIG is holding, and do you really predict these things? So we should be humble about our ability to do this modeling, and I'm saying this as a theorist in finance.
Great.
If I could just to add to that,
Sure.
I think the other concern, I think, with the risk weights, in our view, is that those risk weights are driven off of qualitative factors, largely about product structure and not on the elements that we believe drove risk and drove losses through the last crisis. And those are more things about how the loan is underwritten, what the debt-to-income ratios are, what the FICO scores are, what the creditworthiness of the borrower is. So in our minds, being more risk-sensitive makes a lot of sense, but the rules seem to focus in on the wrong thing.
Sure, and to follow up on that, Mr. Poston, do you think the capital rules should be tailored to the complexity of the institutions that are covered at all, or?
Yes, we would support capital rules that are related to the complexity, but I think it's important to recognize that it's the complexity of the activities that are going on that needs to be focused on. So I think focusing on the complexity of derivatives activities or capital markets activities, international activities is appropriate. One thing I think that concerns me, concerns Fifth Third, concerns some regional banks, is that size is sometimes used as the only barometer of risk. And I think these rules really need to look at the underlying activities and make sure that for the same underlying activity, irrespective of the size of the bank, that it gets the same capital treatment.
It's what you do, not how big you are.
Absolutely.
I yield back the non-existent balance of my time, Mr. Chairman.
Thank you, sir. I'm